In the realm of corporate finance, liabilities refer to the obligations and debts a company must pay. Long-term liabilities specifically are the financial commitments that are due after 12 months from the period, while short-term liabilities are due sooner. Today, we're covering long-term liabilities and why it can be beneficial to understand them. Imagine you're buying a house. When you go to the bank to get your loan, they give you the option of a 30-year mortgage or a 15-year mortgage. There are pros and cons to each, but that's a conversation for a different day. But just like we sign long-term mortgages in our personal lives, companies also enter into similar financial agreements known as long-term liabilities. These obligations extend beyond the immediate future, allowing businesses to plan and budget their earnings to repay these debts. A few examples of long-term liabilities are bonds. Just like I mentioned, we sign long-term mortgages, companies issue bonds to secure funding for various purposes. Bonds are typically issued with a maturity period of more than 12 months. Like how homeowners pay interest on their mortgages, bondholders receive periodic interest payments until the principal amount is repaid. Long-term loans is another example of long-term liabilities. Companies often seek long-term loans to finance capital investments, expand their operations, or purchase equipment. These loans come with repayment periods extending beyond 1 year, contributing to the company's long-term liabilities. And another example of long-term liabilities are lease obligations. Imagine a company's planning to set up a new office or acquire specialized equipment. Long-term lease agreements, such as those for office space, production facilities, or equipment, can create substantial long-term liabilities. If our company needs to buy a tractor that costs $700,000, there's a good chance we don't have that cash readily available to just hand over. These are the types of instances where long-term liabilities come in handy. Think of short-term liabilities as things you need to pay back right away, like credit cards. These are urgent and need quick attention. On the other hand, long-term liabilities give companies more time to pay back their debts. They have a longer period to plan and use their resources wisely. This helps them to handle their financial commitments better and gives them more flexibility with their money. Knowing the difference between long-term and short-term liabilities is important to understand how well a company is doing financially and how easily it can handle its debts. Managing these obligations will help companies stay strong and successful in the long run, just like how we plan our long-term mortgages for stability. Businesses make smart choices with their long-term liabilities to ensure their success. So now that you have a deeper understanding of long-term liabilities and their importance in business, think about how these concepts apply to you. I want to encourage you to ask some of your colleagues or ask your finance department about your company's long-term liabilities and how they shape the business strategies. Also reflect on your own role and how your decisions impact long-term liabilities. Consider what you can do to contribute to the success of these financial obligations. By having these conversations, you promote financial responsibility and pave the way for sustainable business practices that lead to long-term success. Embracing positive change in the corporate world starts with our knowledge and understanding of these concepts. Good luck!